Welcome to Financial Planning Explained. I'm your host, Mike Menninger, certified financial planner, owner, and founder of Menninger Associates Financial Planning. I'm happy to be joined here today with Nick DeVito, one of my staff CFPs. Nick, thank you for joining.
Thanks for having me.
This is the second episode of a case study that we're doing for Barry and Lori. Just to rehash what we talked about the first time. They're both 44 years old. Barry works for a public corporation. He's pretty high up the food chain. He's in the C-level suite. And he was just entered the C-level suite 2 years ago, and his income is taken off. Okay. What we project is that they're going to remain in the 24% tax bracket in 25 and 26, and no looking back from 27 and beyond. Their goals are to retire in 11 years at the age of 55. And we have a nuance lurking out there, two giant nuances lurking out there. They have a potload of debt to the tune of about $170,000 in debt, in addition to their mortgage, short and intermediate debt. And then secondly is they have a $180,000 inherited IRA coming down the pike. So what we were talking about is how do we try to handle everything in such a way to accomplish their goals and objectives and make it so that the IRS isn't getting rich on them.
Yep.
All right. So this excited me. And needless to say, what we needed to do is we needed to dig deeper into their benefits program. We're going to talk a little bit later on about some of their other benefits that we looked into, for instance, medical insurance, life insurance from the insurance planning side. But we wanted to tackle the 800-pound gorilla in the room, and that's their debt. So one of the problems with the inherited IRA is that they can't get their hands on it yet. Secondly is there's another asset that's going to be coming, but it's going to be coming in the form of the proceeds from the sale of their father's house. And the problem with that is there's a delay in the selling of the house for personal reasons, not going to get into, but they're not going to be seeing those assets potentially for a couple months deeper into the year. So what we're trying to look at is like, how can we try to accomplish the debt problem first and then addressing the inherited IRA? We expect the inherited IRA to be coming within a month or so, August, possibly September. The money from the proceeds of the house, probably before the end of the year, but the debt problem's an issue now. So one of the things that two things we suggested, and one helped us understand. We suggested a home equity line of credit, which at first they weren't interested in, partly because, and as we happen to have this all the time, they didn't really understand how it worked. But when we explained how it worked, then they objected for a second reason. And their second reason helped solidify, we don't trust ourselves.
Yeah, there's always one thing that cannot be underestimated and discounted when you're doing any kind of financial planning is the psychology behind it. And this was a big time psychology talking point for them. They don't like debt because of the situation they're in with the debt they have. They were very apprehensive of taking on any additional debt. Even if it made dollars and cents, it was the right thing to do from an interest rate maximization, lowering their monthly payments. To Mike's point, we brought up the idea of the HELOC. We also brought up the idea of a 401k loan, which is another great debt consolidation tool you can utilize. Getting an interest rate lower with the 401k loan, you can take up to $50,000 if you have the $50,000 vested in your plan.
50% of your vested balance up to $50,000.
Yeah, up to $50,000. Yep, exactly. 50% of your up to $50,000. So that's another great debt consolidation tool. From an interest standpoint, you're paying the interest back to yourself as opposed to a bank. And it's generally going to be at a lower rate than some of the high interest debt you see out there, the credit cards, right. Anything above 10%, I would say, is the high interest. So we brought up those two concepts. They were a little apprehensive at first because of, to Mike's point, they didn't want to take on any more debt and they didn't trust themselves. That was part of it too. Once again, great tools they can use. You have to understand how people operate when you're making these kind of recommendations. And I think we were able to work through that and kind of dispel some of their fears they had by really explaining to them. Because one thing we always say is people are afraid of things they don't know.
Correct.
Once you understand them a little bit more, it's easier to feel a little bit more comfortable with them.
So how we addressed it is what we have a tendency to do is when we have kind of a process, if you will, for doing a comprehensive financial analysis, we request that the clients upload all of their documents for us to be able to look at, review, to get an idea of what the level of effort and the scope of work is. And then our first meeting is to typically review everything they have going on, teach them what's going on, and then subsequent meetings, we'll be talking about specific strategies and recommendations. But when we got glaring stuff at us, we want to address it immediately. Okay. And the glaring thing was all the debt. So one of the things that we were able to do is, even though he was reluctant, Barry went ahead and took a $50,000 loan from his 401k. So let's talk about that. So what happens is that when you take a loan from your 401k, it is $500,000 401k is now $450,000. So he lost the investment of those $50,000. People will complain about that and everything else. Hey, you lost it. So what we look at it is a little bit differently, is we considered that $50,000 a fixed income. Why is it a fixed income? Because he's contributing back and he was paying himself back somewhere just shy of 8%. First of all, an 8% loan stinks. However, I would much rather give myself 8% to give the stinking bank 8%. The real true downside of a 401k loan is that the $50,000 that he received is considered tax-free because it's a distribution of principal. But what he puts back into the loan, if he stretches it out over 5 years, he's going to end up putting $60,000 back in because the extra $10,000 is interest. That $10,000 effectively was after-tax money going into your 401k that comes back out pre-tax, which means it's double taxed. However, remember, that 8% is coming to him, okay? Secondly is what we were doing is we were trying to take care of immediate debt. So what we were able to do is we were able to take that $50,000 and immediately paid off his credit card debt. Paying off the credit card debt was about $30,000, but just in itself, the credit cards were about $1,200 a month in minimum payments. That was $30,000. Then we were able to take the other $20,000 and pay off a couple other things. So actually, the cost of his 401k loan is to the tune of about $500 to $550 every 2 weeks, or $1,100 a month. But he improved his cash flow by about $1,500. So we didn't hurt his cash flow. We took and analyzed and snagged the highest interest rate stuff we did, and it turns out that he was saving himself to the tune of about $500 or $600 per month just in interest.
Yep.
Okay. And so that was the start. And it also gave him a few extra $100 a month in cash flow, which, interestingly enough, now we're driving into combination of paying down other debt because now he has the extra cash flow. Subsequent to that, now we have a plan for the inherited IRA. And so this is a nifty plan. So what we're doing with the inherited IRA is we're waiting. He's going to know his bonus. Even though he doesn't receive his bonus until November, he's going to know what his bonus is in October because that's the end of the company's fiscal year. Furthermore, he gets his RSUs. So what's going to be able to happen is come mid-October, we're going to know exactly what his income is going to be in 2025. And with that, that gives us the ability to do a Roth conversion, which we're going to do. And I think it turned out to be about 70,000 or something like that.
The inherited IRA distribution.
But we're going to use that. Yeah, I'm sorry.
Yeah, the inherited IRA. Yeah.
Right. Okay. So we were able to do a $70,000 inherited IRA distribution. All right. Now, so the fact of the matter is that what we're going to do with that $70,000, imagine that we're going to pay off debt. All right. So now we pay off the debt, which further improves his cash flow. Now, we're going to wait with paying off the 401k loan because we're going to pay off the 401k loan, but we're going to wait until the money comes in from the sale of the house proceeds. Now, so what also is going to happen here is we figure if we bring him to the top of the 24% tax bracket, we already know that his tax is going to be $80,000. He is given the choice. First of all, the federal government wants their money. Okay. That's why they withhold taxes and everything. That's why they withhold taxes from your paycheck and why self-employed people have to do quarterly estimated taxes. But to avoid penalty, you have to make a safe harbor contribution. The term safe harbor, as it applies to this, is you need to either have 90% of this year's money in the system or 110% of the prior year. Well, it just so happens that because their income is higher, they're going to be at 110% of last year's tax return, which means we can take that $70,000 out. And while it's going to be taxable, we project that he's going to have a tax due in April of about $20,000, but he doesn't have to pay it until April.
Yeah. And that's another thing we always ask the client is, are you comfortable with that? Because some people, quite frankly, aren't. I mean, you can, once again, the dollars and cents answer to that question is you take the distribution now, don't withhold, you withhold whatever you need to for safe harbor. And then the balance, the $20,000 that Mike's referring to, you wait until April to give it to him. Because then for those 4 months, you can be earning the interest on that $20,000 as opposed to the federal government. Flip side of that is some people aren't comfortable with that. They don't want, even though they know it makes sense, they don't want to write that big tax bill. Barry was comfortable doing that and said, okay, let's do it. They can get their money when they get their money.
He's got an MBA. He understands this stuff.
Yeah.
But, it's an MBA and we have CPAs as clients and we have CFOs as clients. The problem is that they're really good at what they do, but the personal finance, they may not have the education. And then once again, it's their own finances, which means that some of the emotions can get in the way.
Yeah.
So that is our strategy for that one. Now, what we're doing is we're digging into the deferred comp. Okay.
The other thing to note with that is, to Mike's point, we referenced it several times, is we want to try to get that inherited IRA out as soon as possible this year and next. Another lever we have to pull is he's not currently maxing out his 401k. He's making contributions to his traditional 401k, getting the tax deduction for it. One of our recommendations was, let's ramp up your traditional 401k contributions for the rest of the year, allows us to take more of that inherited IRA out. And same with Lori. She's not actively contributing to her 403b through work. 403b is essentially the same thing as a 401k. It's just for public institutions, governmental institutions. So Lori could also increase her 403b contributions for the remainder of the year, which would also allow us to take more out of the inherited IRA.
Correct.
So those are two other levers we can pull because one, to Mike's point, we're trying to stay under that 32% tax bracket. Any way we can drive their income down to do so to get more of the inherited IRA, we're going to try to do. And to Mike's point, the deferred comp is another piece of that pie that we can begin to utilize.
And that's what we're going to be looking at for starting calendar year 27, barring if all of a sudden, one of the issues associated with deferred comp is it's generally a program that is much like other company benefits where, everybody goes through their open enrollment for their medical and all kinds of stuff. And that's usually in October, November. The same with deferred comp. Deferred comp is typically a calendar year program. We're digging deeper into the deferred comp because there are a lot of nuances associated with deferred comp, but the deferred use of the deferred comp may be very, very applicable in this particular situation, simply because if they're planning on retiring at age 55, we want to dig deeper into understanding exactly how the deferred comp is going to be distributed. So the whole idea of deferred comp, I've also heard mirror 401k, non-qualified 401k. Basically what happens is it's typically reserved for the higher compensated individuals. And you can say, I want to defer my compensation, and you can pick out $50,000, $100,000 per year. And what happens is that they withhold it much like a 401k and get set aside. You invest it like a 401k. But when you retire or terminate employment, that's the point with which it then gets distributed to you. Okay. And there are programs that you could take it. So long as he's staying with this company all through until he retires, this is perfect for him because if in fact they do retire at age 55 and he chooses to take it out for 10 years or 5 years, he's taking it out during the periods that they're going to be in a lower income tax bracket, which fits them perfectly.
And yeah, one of the things to note with the deferred comp is it's not guaranteed. There is a level of risk when you're doing the deferred compensation as opposed to a 401k. With a 401k, it is your asset. You own it. The deferred comp is viewed as an asset of the company that you're working for. So if that company were to theoretically go belly up, your deferred comp is not guaranteed. So there is an element of risk associated with that I always think is very important to explain to anyone when they're utilizing this program. The reality of the situation is a large publicly traded company, they're probably going to be there in 10 years, but crazier things have happened, and it's just important to understand that risk. Furthermore, oftentimes the deferred comp, every plan's a little bit different. It's not as uniform as a 401k because there's not as much protection afforded to it. Sometimes you will have to, when you're making your deferred comp elections, pick the years you want to receive that distribution. Other times it might just be contingent upon your retirement. So everyone's a little bit different in how they operate, but they're all similar in that sense.
And so the problem is, and this is where we are right now. I mean, this is sort of work in process. We haven't dug deep into the deferred comp yet, but the reality of it is that we don't foresee the need for the deferred comp until calendar year 27, at which point in calendar years 25 and 26 is when we're going to do everything in our power to try to pull as much of that money out of the inherited IRA as possible. So right now we're going to take a short break and we'll be back with you in just a few moments.
Do you keep up regularly with your investments? Where exactly are your hard-earned dollars going? Are you financially prepared for an emergency?
I'm Mike Menninger, founder of Menninger Associates Financial Planning. We believe that education and knowledge are powerful, and we want our clients to understand why we are making the recommendations that we make. It's your money, and you deserve to know where it's going, because it's not how much you make, it's how much you keep. So call us today to discuss your financial concerns. Welcome back to Financial Planning Explained as we continue on. So what we're going to do now, again, we're keeping an eye on the inherited IRA. So we're going to take roughly 70,000 or whatever that number is out this year, and we don't have to withhold for taxes simply because of the fact that we have enough going into the system to qualify for safe harbor, which is going to be 110% of last year's tax because their income is up. So what we're going to do is we're going to take the $70,000 out and use it to immediately pay off debt. Now, one of the things that we're going to take into consideration by the time we finally do that, we're going to have a good sense as to when they're going to be receiving the other balance of money from the sale of the house. And what we'll do is we'll take a portion of that money, carve it out, set it to the side, and we're going to say, this money is going to be set aside for paying taxes next year. And if that number happens to be $25,000, we may suggest to them take $25,000, put it into a CD that matures just prior to April 15th. You know, today it might be a 6 or a 7 month CD, put it into money market. But it's basically carving it out so that it's safe. Or, like I said, if they know that the sale of the house is coming, they always have that. And then what we're going to be doing is in January, actually, that's what it was. In January, we're going to be taking some more inherited IRA distributions. And if we needed, we can even carve out some of that to be paying the taxes. So we have a lot of moving parts. And the interesting part about it is that we have enough from the inheritance to completely wipe out all of their debt with the exception of the mortgage. And in doing so, what that does is that improves their cash flow, because I jokingly say the one thing I am a master at
spending other people's money.
Spending other people's money. That's correct. So, you know, and I joke by when I say that, but the fact is that what are we going to be doing when we generate $3,500 a month extra in cash flow? So here I am spending this money. What are we spending on? We're probably going to be doing deferred comp. So if we're doing deferred comp, and that's a couple $1,000s a month they're socking away for retirement, it's basically like increasing their 401k. We're going to be maxing out at least Barry's 401k. Not quite sure whether we want to do Lori's Piecers or not, her 403B. Mm-hmm. That's debatable. That's a wild card. We have the extra 23.5 that we can put in. We're going to be recommending that he contribute to his employee stock purchase program, and as well as saving for college. I mean, so like I said, I'm really good at spending people's money. Why? He has goals. And if you have goals, then the best thing to do is to pull the money out immediately, because you pay yourself first mentality, which is a very, very good thing to take into, it's a very good thing. Pay yourself first, because when you do that, you begin to accumulate assets as opposed to spending them. To Nick's point in the first episode, what was the term you used? Like when people make more, they spend more?
Income creep. Expense creep. I don't
Right.
remember the term. It's one of those.
Basically, it's the truth. Okay. If you're making 80 grand, you got to raise to 90 grand. It's a beautiful thing. It's no time. You're spending the full amount of your paycheck. You go from 90 to 110 in no time. You're spending the full amount of your paycheck. But if you do the pay yourself first mentality, once you go from 80 to 90, you take that extra and sock it away for yourself, then you're not seeing it. Now, I'm not saying do all of it, because sometimes it is nice to be able to improve your lifestyle, but still want to be driving money, because they have, I want to say, aggressive goals.
Mm-hmm.
You know, if you want to retire at age 55, let me tell you something, you need to be saving an awful lot of money. Okay. So take that into consideration. So
yeah, absolutely. And especially to Mike's point, the paying yourself first, it's powerful for anyone, but especially when you're dealing with individuals that maybe had an issue with spending in the past, it really does help them, and set that aside. And I think another thing I always think is very powerful too, especially when you're dealing with any kind of debt or savings goals, I think being able to see it and seeing your progress is very helpful, whether that's tracking it through a spreadsheet or just watching your account balance go up over time because you know you're saving. It's very encouraging, and I think it really helps keep people on the straight and narrow so they can achieve their goals.
Right. So that's handling some of the cash flow stuff. And so what we want to talk about are some of the other benefits that we were taking a look at. They got a good medical insurance plan, actually through Lori's Peachers, or through a school district. Yeah. Okay. Barry doesn't take the benefits from his company because the benefits provided by the school district are far superior, and that's their choice, whatever makes sense to them. We always just want to make sure that they're adequately insured. But when we were taking a look at their life and disability, we'll start with disability. They offered Barry 60% of his salary. The problem is when someone gets used to a salary of $250, but other compensation of $100, they're used to $350. The problem is that disability is based on your salary. So 60% of $250 is $150,000. Trust me, you go on to long-term disability, you're not getting your bonuses, and your RSUs are going to come waning down.
And furthermore, too, the 60% that Mike is referring to, the company is paying for that. And because the company is paying for that, that 60% benefit that he would be receiving is also going to be taxable.
That's correct.
So not only are you getting a reduction, but you're still paying the taxes on that benefit, further reducing your take home.
Correct. So what we're going to be doing is, we did see in their benefits that he can buy up an extra 10%. So there's no question in our mind that when it comes time that they do open enrollment, that he steps it up to the extra 10%. However, one step further, which we don't yet know, okay, we do know that he can put his 10% in after tax. You know, everybody on the surface is going to say, woo, if I have a chance to get a tax deduction, I'm taking it. And we always say time out. If you were getting a disability and you're already taking a haircut in your income, do you want to pay taxes on top of it? No. Okay. There is a little known rule out there that also gives the employee the opportunity to take the benefit provided by the company and take it as imputed income. So let's say, for instance, the company pays $200 a month for Barry's disability insurance. Some companies allow the rules allow it. Most companies aren't aware of it, but the rules allow Barry and employees to be able to go back to HR, to the company, and say, hey, guys, let me take that $200 a month as imputed income. What is that imputed income? That means he gets income on $200, right? And therefore he's taxed on it and everything else like that. But what it's doing is it's taking the company benefit of 60% and it's making it after tax. Because if you really get down to what's going to happen now is he'll get that 60%, call it 70 now, 70% after tax means his paycheck's going to remain the same. Now, in his case, no, because he's going to be losing the bonuses and stuff. Mm-hmm. But for everybody else, 70%, I challenge almost everybody to take a look at their paycheck. And I can guarantee you, in almost every single case, your paycheck is less than 70% of your gross pay. Now, mind you, another thing that happens is when you're on disability, you're not contributing to your 401k either. So, you know, that's a way to at least retain the income that you're used to retaining is to go through that. And so we're going to have to spend a little bit more time. Now, the good news is we don't know yet whether his company offers it. He's in the C-level suite. I'll bet you that if his company doesn't offer it, that
he can make it happen.
he can make it happen. Exactly. So, I mean, it costs the company nothing to do.
Mhm.
It's just a function of getting payroll to coordinate with your benefits to be able to allow for it.
Exactly. Yep. And I mean, in the same breath, when we're talking about disability insurance, one thing we always like take a look at too is life insurance, making sure they're adequately insured from that standpoint as well. So taking a look at what they have going on. Barry, through his employer, they provide 2x his salary. So he has a death benefit of $500,000. He also opted into supplemental coverage and added an additional $250,000 for himself. Barry also has a private policy for $500,000, and Lori has a policy for $50,000 as well. So when we take a look at this, the employer provided life insurance isn't necessarily a bad thing, but there are some nuances and downsides to it. Primarily, if you lose your job, you no longer have coverage. So that's always something to keep in mind. And Lori's coverage is very low. While Barry is the breadwinner, I think oftentimes people look at that and say, okay, well, Barry's the one making the money. Lori doesn't need the coverage. That's not necessarily the case, because in most cases, if not all, if the lower income earner would have passed away, there's obviously going to be an emotional gap that is left, but there's also a financial gap. That lower income earner is still contributing to the operation of the family, whether it's taking care of the kids, managing the finances of the house, doing upkeep on the out. There's a financial component to that too, that if they were to pass away, there would need to be an additional source of funds to help with that.
After school care.
Exactly.
You name it. There, do not underestimate and she works, but even the stay-at-home parent carries a tremendous amount of value that you need to be able to replace, because you may end up finding yourself spending $1,000 a month just for daycare, okay, for your children, even if it's after school or whatever. You need to make some type of arrangements. And so one of the things that we looked at is we also had him produce what the costs of insurance are at work that he's buying up. And so what we actually ended up recommending is that Barry buy a separate policy outside of work, because honestly, you usually can buy insurance privately cheaper than what you get at work if you're average or above average health. Why do I say that? Because the only thing life insurance looks at work is gender, male, female, tobacco user, smoker, non-smoker. So you take a male non-smoker, okay? You put a marathon runner sitting next to the 450-pound person with heart disease, cancer, diabetes, and anything else you could possibly think of. They're paying the same rate.
Yeah, the only other thing they're looking at, to Mike's point, they look at smoker, non-smoker. They also look at your age, gender, smoker, non-smoker. Those are the three big hitters. And to Mike's point, it doesn't really matter anything above and beyond that. And that's where you can get cheaper, not always initially, but when you look at the long term, because obviously when you're younger and you're getting it through an employer and you're in good health, it still may be cheaper through the employer. But if you're getting a 20-year term, over the course of those 20 years of your company, by year 15 through 20, you're likely paying more through the employer than you would, because if you get a 20-year term policy now, your rate's going to be locked in for the whole 20-year term.
Correct. And so what you find is that company policies are age banded: 40 to 44, 45 to 49, 50 to 54, 55 to 59. And it's not straight line. It is exponential. So what we do as it pertains to evaluating life insurance policies. So what we did with Lori, we said, hey, all right, guess what? Thinking about retiring in about 10 years. Okay, great. The other thing too is that the children, the youngest is going to be 23. So we don't have to protect Lori as much. As far as Barry goes, being insurance policies are 10-year policies, 15-year, 20-year, 30-year. What we looked at is they already have a 30-year policy that takes them all the way out to age 65. That's one of the $500,000 policies that he has, is that we're looking at taking them to age 60. Arguably, they claim they're going to retire at age 55. It's a great goal, but I still think that we should supplement it and take it out to age 60 as opposed to age 54, basically age 59.
Exactly. And another component to that is the Social Security element that goes into it, because you can collect your deceased spouse Social Security when you turn age 60. So 60 is a good goal for them, because even if they don't necessarily retire at 55, we're building in those few extra years of flexibility for them. But also looking at Social Security, you can hop on your deceased spouse Social Security benefit and collect as a surviving spouse when you turn 60. So that is kind of a finish line too we look at for life insurance, knowing that the cavalry's coming in there.
Correct. So there's a lot of different things we're looking at. Lastly, before we run out, is what else were we looking at? Some of the other strategies. We talked about paying off the debt. We talked about how we're going to get the money out of the inherited IRA. I will tell you what we're also going to do in future years. This year, we didn't have to worry about safe harbor because of the fact that they already have into the system 110% of the prior year taxes. Next year, it's either going to be 110% of this year or 90% of next year. And I can assure you, 90% of next year is going to be cheaper than 110% of this year. So what we're going to do is we're going to carve out and utilize the inherited IRA as the sacrificial lamb. So meaning that what we'll do is we'll project out during the course of the year as to how much his income is going to be, subsequently how much we can pull from the inherited IRA. And let's say next year we could take 50 out. And then we realize to be able to get 90% into the system, we need to give the IRS another 20 grand. So what we'll do is we'll carve out 20 grand within the inherited IRA, park it in something that's guaranteed to not go down, and we'll take that out of the inherited IRA in late December, and we withhold 100% and we send it to the Fed. And what that does is basically, if you take it out from an inherited IRA or any type of retirement account, it's as if it was distributed all throughout the year. So therefore, basically, we're covering the taxes. Meanwhile, we're getting creative with it. If he has $20,000 tax bill due, I'd rather be earning 4% on that. It's $800. Mm-hmm. Would you rather give the government the opportunity to earn it or you?
I'd like that $800.
Just don't. I didn't ask. So what other tax strategies you got? The insurance planning, the 401k, the 403b, the deferred comp, the inherited IRA. So those were all of the big picture items that we looked at and really didn't spend a lot of time on the college thing. But a couple things we look at with the college is, we have some nifty software. And I think we're going to talk about the estate planning. I'll go into that a little bit too. With the college planning, what we also do is we try to guide parents into thinking of ways that they can improve their child's credit. And one of those ways is that the child can actually take out loans and you can help pay those loans while they're in school so that when they graduate school, they have already established credit. The other thing is that if they don't have enough money in the 529s themselves, no big deal. They could fund it through cash flow. Okay, now instead of sending $10,000 to the school, they always have the ability to say, all right, the bill's due August 15th. I'm going to take $10,000, run it through a 529 plan in money market. Okay, so there's no cost to buy, no cost to sell. You turn around 2 weeks later, pull it out, send it to the school. Guess what? They got a $10,000 Pennsylvania tax deduction, which means they're getting 3.07% of that back. That's $300
in their pocket.
Right? May as well, because you can. The other thing about the wills, that was something we needed to make sure that they addressed immediately. So when people don't have wills, in their case, they don't have wills and they have young children, we strongly encourage that they see an estate attorney immediately. Okay. There are those who are do-it-yourselfers. Okay. That's okay. There's nothing wrong with that. We also have, interestingly enough, we purchased something that's open to everyone. I call it the TurboTax of wills. Okay. In that it enables the individual to go ahead and fill out and go through, because it prompts the questions, and all they need to do once they're done is to print it and get it notarized. we offered that to them. They're taking advantage of it. And now that I think about it, I don't think they completed it. We need to get on it.
Yeah, I think you're right.
So anyway, you have anything you want to add?
Nope, I think that was everything.
All right, cool. So anyway, standard stuff. It's like I said, everybody's the same and that the approach is the same. We take a deep dive into the financial planning, a comprehensive financial analysis. Everybody's different because their situation is unique. And with their situation being unique, there are different cool strategies that we can employ. Some work for some, not work for others. It's just cool stuff. And I love this.
Me too. Me too.
So thank you for joining. I hope some of this may have applied to you. I hope you learned something. And I look forward to seeing you on the next episode of Financial Planning Explained. You have a wonderful day now. Thank you. Thank you for watching this episode of Financial Planning Explained. We strive to provide an educational experience for all of our viewers, and what we struggle with at times is topics. So if there's an idea or a topic that you would like for us to discuss on a future episode, please email us at admin@maaplanning.com, or you may enter it on the Contact Us page on our website at www.maaplanning.com. Thank you in advance for participating and helping make our show successful.